Welcome to the first of what I'm planning to be a number of videos on kind of the results of some of my own research into investing over the past 6 or 8 months. The main topic that we'll be focusing on here is what I'm terming SILC Investing. So SILC being an acronym for Stock Index Leverage Compounding, and the tech background showing you here that we are ETFs that we'll be focusing on primarily are all tech related. We've got TECL, TQQQ, and SOXL. Now, to kick things off, certainly one of the most compelling arguments for this type of stock index investing is some of the historical performance. I will say up front, I don't believe these are going to be achieved in the same manner, but I do believe that they will outperform over the long run. So in this case, we've got TQQQ, which is triple QQQ, and that achieved a very amazing return of 33.91x from February 2010 till September 13th, 2019, or yesterday as I make this video. Now, I don't know about you, but I did not have any investments that achieved a 33x return. There were a few stock investments, like Netflix, for example, but generally speaking, out of the 25,000-ish stocks that are out there, very few came even close to doing that. So that's what I think is very exciting about this. It is index investing, but at the same time, because of some leverage and compounding, it's really achieving returns that are just exceptional. So one thing I do want to say up front, I would greatly appreciate it if you are interested in this type of content to subscribe. Certainly got a lot more things I want to talk about on here from some of the research. Let's get into some of the initial data, kind of a quick summary, just to give you an overview here. What I've included is TECL, as I mentioned, TQQQ, QLD, which is double leverage versus triple, SOXL, which is a semiconductor index, but it's also, again, triple, UPRO, which is triple the S&P 500. I've included some just random stocks that I put in here to give you also some perspective. Some of these, of course, are components of TQQ or TECL, but let's get into a quick overview of this, and then I want to show you some of the reasons that without having, I think, a bigger perspective on both how compounding works, how leverage affects things, but also just how these stock indexes on average tend to perform. And what I say about is you can definitely go through periods of minimal or even negative performance, and you just kind of have to sit through it, basically, with the understanding that the market timing is incredibly difficult, if not impossible, and I'll show some research on that. So the main thing is letting compounding do its magic for you. So quickly, we've got here TECL. Well, actually, let's jump from the 10-year that I mentioned. So this is 33.43 just because I did this spreadsheet on Monday and did the other number on Friday and making the video here on Saturday. But over 10 years, 33.43. By comparison, the double, or QLD, was half. And the QQQ was almost a tenth of what, so that's the difference of compounding. If we back up a bit and want to say 11 years, TECL, of course, was the clear performer, and it just happened to be, to some degree, luck that they started their fund, or ETF, right at the end of the Great Recession. So that's one of the reasons I'm saying I don't believe these type of returns are going to be achievable, but I do believe that conceptually these will outperform very well over longer term horizons. So going up to 5-year, SOXL was the big winner. And let me just back up to the 10-year. If you look at some of the individual stocks, Netflix was the clear winner by far. GE was certainly a serious underperformer. And this is, you kind of had a random difference here. Amazon certainly did well, but did not beat out TQQQ. So one of the big advantages, of course, is when you get into picking individual stocks, the risk of ruin, so to speak, is certainly much higher relative to an index. And of course, if we were to look at some of the top performing stocks, i.e. Netflix is certainly one, I believe is actually number 2, Ulta Beauty being number 1, Align being number 3, but these are individual stocks, like 5 top stocks out of 25-ish thousand stocks, so very hard to pick the right ones and very hard to sit through with it in terms of their volatility and whether that's going to be the one, so to speak, that really pays off. And so that's what I really like about this whole index concept, but giving you the advantage of leverage and compounding. So getting into the 2-year perspective, things this past 2 years, we're getting into kind of more of the up and down, and not a whole lot happening overall. So, but TECL 0.97, and then on the 1 year, it's certainly nothing exciting. 9% for SOXL was the winner, relatively speaking, everything else not doing a whole lot. But let's show you, let me show you kind of why it's difficult without a bigger perspective to be able to achieve the full effects of compounding. So this is TECL, the very start of TECL. So this is the end of 2008, December. And your first year, certainly you'd be pretty happy. You went from 4 to 10, so you're happy in that respect. But look what happens over the next 2 years. We were basically end the year, or start the year here at 12. We go down, we go up, we go down, we go up, we go down. And 2 years later, literally, you're almost at exactly where you started. And meanwhile, I'm sure other things in that shorter term did well, and I think you'd be very inclined to move on to bigger and better things, so to speak. But then that's where the compounding can be deceptive in the short term, and I'll show you some of that in just a second. But advancing forward, we kind of we get into a big run, go through another period of nothing, 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 and then we'll get another pop here, actually a very nice pop, and we're getting back into this nothing, nothing, nothing. That's just one of the things I wanted to show, that I think you can be lulled to sleep, so to speak. I mean, these are very big numbers in terms of total absolute returns, but on a more, and this is a weekly chart, by the way, but on a week to week or month to month or year to year even, it's not nearly as exciting or interesting, and that's where I think having the bigger, longer term perspective on this comes in to help you. So speaking of perspective, let me show you. This is double-digit numerics. He's a financial mathematician in New Zealand. The site has not been active for a while, but he produced a very good paper called The Long-Term Behavior of Leverage ETFs. There's a lot of myths out there that will say that leverage ETFs are terrible things to hold. Leverage ETFs are not suitable for long-term buy and hold. Talks about some of the different comments that he's seen on there. And the whole reason with that is volatility drag. And I'll show you a spreadsheet kind of showing what volatility drag is. But the net is he shows that it is nonsense, basically, in the respect that even at 1x leverage, you're still going to have volatility drag. So where's the magic number between, volatility drag is always there, and this is the mathematical formula that is there. Now, it certainly works more against you with the bigger leverage, obviously, but he's showing that there is an optimal point, basically at about 3x. So, for example, going back 1950 to 2009 shows for the S&P that the optimal leverage is 3. The NASDAQ itself is 2.5, I guess, basically. So that's kind of the point, is that you can take some of this back in time and show that it works for longer, quite long periods of time. And in fact, I'll show you probably the ultimate, taking it back in time. This goes back to 1800. So what do we have? We have in yellow, or gold, I guess, basically, is equivalent of a U-Pro, or 3x the S&P, and the blue or purple, depending on your screen, this is the S&P 1x. So as you can see, that the triple leverage goes literally exponential, because if you look at this scale, 10 to the 15th, I mean, that's, literally exponential numbers to even keep it on the same chart. And that is the power of a stock index with leverage and compounding. One of the things I will get into in a future video here, but this is an article I wrote from some other research on stock market timing, why it's so difficult. But the main point I wanted to make here, the paper really made, it was a paper done by the Brands Institute, was that on average bull markets outperform nearly 5x in gains versus bear markets. So the point being that while most people stress, for example, about bear markets, the net is you really, really need to be focused on not missing the bull markets, and because the payoff is substantially greater than the losses that you'll endure. And of course, by being in an index, excuse me, that gives you certainly more security, relatively speaking, than an individual stock in terms of going to zero. But this is, I think, another video in the future to come. So let's get back to some of the other data that I wanted to show you. So moving on to quick things here. Volatility drag. What is volatility drag? If you have a 1x leverage and you have 100 and you go down 20%, you go back up 20%, kind of on the surface you'd say, well, I'm back to even, right? I went down 20%, plus 20%, they equal out and I'm back to even. But It's not correct, because what happens is your 20% gain is based on the amount that you started with after the loss. So in other words, you went 100, you went down to 80, your 20% gain is actually only based on 80, not on 100, and therefore you're actually back to 96. Now, it gets worse with leverage, and that's where the basic warning with using leverage is involved, and certainly on highly volatile instruments or non-indexes. That's where leverage can really be your undoing, so to speak. But as I mentioned, that was double digits numerics. Big contribution to the field was showing that there was actually an optimal leverage on average for most stock indexes, and that volatility drag is always present. I mean, 1x has volatility drag as well. So the flip side, or the positive, is the leverage gain. It works in much more magnitude than you might think. And so in this case, what I've shown here is 3 periods of 10% gains. Let's assume each year the indexes gain 10%, gain 10%, gain 10%. If you're at 1x, you are, not surprisingly, at 133. So basically your kind of expected arithmetic 33% or 30% return. 2x, you end up at 172%. And 3x, you compound all the way up to 120%. So in fact, even though you are triple leverage, if you were to get steady gains like that, you actually end up at nearly a 4x return. And that's because you're compounding on top of the compounding. And so that's where really the stock indexes like this pay off, is steady, longer term gains really add up, I guess magnificently is the word that I'll say. Now, one of the things I mentioned is that compounding is very, very deceptive. And the question that I think kind of shows that is this one here. If you were to take 1% per day, each day at the end of the year, how much gain would you have? The normal response, or at least what I certainly thought initially, was, well, it's 365 days a year is 1%, so 3.65x gain, right? But not true, in the sense that you are actually compounding 1% each day, and the compounding builds on the compounding. And so I just wrote a quick program, so it's not, I did 30 days for the interval, so you actually end up at like 12.25 for the total 365 days. But what you can see is the growth here. We go 1.35, 6, 8, 19, 26, 35, and suddenly at the end of the year, 37x. So that's beyond just stock investing. I mean, if you take a skill, and if you were able to, for example, try to improve at 1% a day, which might be hard, but that's certainly an ideal, you would at the end of the year be 37x better, not 3.65x better. And so that's where the small gains really can add up. And this is the chart showing kind of the basically exponential curve. So again, it's just to impress upon you some of the deceptiveness of compounding. This doesn't seem like there's a whole lot happening, and suddenly, if you're at 6 months here and then you're at here, it's a huge jump. So that's kind of the quick overview for this first video. So again, what I want to show from some of the research that I've done is some of the benefits of having stock indexes with leverage and allowing them to compound. One of the things that I will look into in more detail is REITs, which are real estate investment trusts. And I have an idea, at least, that maybe an optimal combination is really using the SILC Investing like in a 60-40 mix, where you've basically got your leverage indexes at 60% and REITs at 40%. The reason for that is that REITs are basically strong dividend payers. So you can get REITs at 5% up to 12%. They don't tend to move nearly as much because they're not really growth stocks or anything. But the point is, as I showed you, there were periods where you could go 2 years with absolutely nothing happening. And I think that's hard to sit through that. But in the meantime, if you have some of your money in REITs and those are paying out every quarter, you're still gaining in the sense while it lets you be more patient. So that's where, and the Norway Wealth Fund, for example, had, I don't know that it's 60-40, but they kind of did stocks and stock indexes and also real estate, and that was to sort of counterbalance it. So that's something that we'll get into in some of the other videos coming up here. But the main takeaway here is the optimal leverage on stock indexes appear to be 2 to 3x's, and that's definitely not on individual stock. The risk of ruin on individual stock is certainly much, much greater. But the stock index is over time, it's 2 to 3x, and so I'm focusing primarily on 3x. So, as I mentioned here, do your own research, of course, but from my research and what I wish I knew 10 years ago, it's very hard to beat the minimal risk of a stock index going to zero and the magic of long-term leverage compounding. I don't believe 33x and 57x returns that I showed you here. They did in fact happen, but I don't know that they're likely to repeat soon, but the fact they occurred. And more importantly, as I showed on that one chart, since 1800, the U-Pro equivalent, that exponential return that you saw there was really boiled down to 20.4% a year compounded. And so it shows certainly impressive possibilities. So there's a lot more to come here. I would definitely appreciate if you are interested in this to subscribe, primarily to sort of show that there's reason for me to continue making videos like this. I think there's information that I've discovered that I don't know is out there elsewhere. It's certainly information as I mentioned, I wish I knew 10 years ago, so I'm happy to share it. So thanks for your help and best of luck with your investments. All right, a little bit of a bonus at the end here. Thanks for sticking around to the end of the full video earlier. So what I wanted to show here was kind of a quick virtual experience of making 50x return on your money. So this is the TECL chart, the triple ETF, and we're going to run through 10 years of data, so we're already underway here. The green line in the middle is interesting to pay attention to. If you look on the right hand side, that's your total return from your inception, or from the start of the ETF, so end of 2008, beginning of 2009. And you can watch it kind of fluctuate around and give you an idea mentally what it's like holding as this progresses. This dip right here is the end of December 2015, where we have a bunch of oil concerns. As you can see, it was up and down, and they've been scary holding at the time, but ultimately popped right on out to another nice run. And this is kind of what I wanted to show, is just sort of the mental fortitude it takes to hold when times are uncertain, but basically letting compounding do its magic for you. So we're now getting up almost into present day. This is October, November, December of 2018, where we took a big spill, and then we're right back up in 2019. So just a fun bonus, but again, hopefully helps you prepare for SILC investing. Take care.